this video, you'll learn the basics of journal entries, T accounts, ledger posting, preparing an income statement, and posting a balance sheet. We'll walk through each step to help you understand the financial information flows through the accounting cycle. So, let's get started.
So what is journal entry? A journal entry is a record of a business transaction showing its debit and credit effects on accounts. It's the first step in the accounting process, chronologically recording each transaction. This detailed record helps maintain a complete and accurate accounting history.
So what is T account? T account resembles the letter T with the account name written at the top of the left side represents debit side, while the right side represents the credit side. Debit increases assets and decreases liabilities and equity. Credit decreases assets and increases liabilities and equity. So for example, Labausas deposited 165,000 in the bank accounts in the name of the business. Cash. So cash. It's debit. Okay, debit. 165,000 Labusas capital. A cash account shows debit of 165,000 representing the increase in the cash. Labausas capital account shows the credit 165,000 representing the increase in owner's equity. Both are accounts affected by this single transaction, demonstrating the fundamental principle of the double entry bookkeeping.
Is general ledger. The general ledger is a record book of all money going in and out of a business. Each account, like cash, sales, rent, has its own page or section. For example, if you pay 1,000 pesos for rent, it is reported under rent expense. If you earn 5,000 pesos from sales, it is recorded under sales. So, what is a trial balance? So, I have here an example of trial balance, or an explanation rather. A trial balance lists all account totals from the general ledger to check if debits equals to credits. So the purpose of this is to make sure records are correct and balanced. So I have the example of general ledger. The general ledger is where we record all the money a business receives or spends. Each type of transaction has its own account. For example, when the business receives 10,000 from the owner, we record it in the cash account and also in the capital account. If the business buys supplies worth 2,000 pesos, we record it in the supplies account and subtract it from cash. If the business earns 5,000 from sales, we record it in the sales account and add it to cash. If the business pays 1,000 pesos for rent, we record it in the rent expense account and subtract it from cash. So, I have also an example of trial balance. After recording all transactions in the general ledger, we take the final total of each account and list them in the trial balance. We place cash, supplies, and rent expenses under debit because they are assets and expenses. We place capital and sales under credit because they are owner's investment and income. When we add the debit side, 10,000 cash plus 2,000 supplies plus 2,000 rent expense is equals to 13,000. Then we add the credit side, 8,000 capital plus 5,000 sales equals 13,000. Since both sides are equal, the trial balance is balanced.
So, good day. I am Jillian Largo. I am discussing about the posting income statement. So, an income statement is a financial report that shows businesses, revenues, expenses, and profit or loss over a specific period, usually a month, quarter, or year. It tells whether the business earned a net income or profit or had a net loss, so spent more than it earned. The main parts of an income statement are revenues, expenses, and net income or net loss. So, ang revenues is money the businesses earned like from sales or services. Then ang expenses, costs spent to run the business like supplies, rent, or utilities. Then ang net income or net loss, the result after subtracting expenses from revenues.
Posting a balance sheet means transferring the final balances of all your accounts, like assets, liabilities, and equity, into a formal financial statement. This is called balance sheet. This shows what a business owns, asset, what it owes, liabilities, and the owner's claim, equity, at a specific point in time. It helps summarize the financial position of the business, usually at the end of an accounting period.